Smart money is doing one thing with gold right now, and retail investors are doing the exact opposite. Here is why that gap matters more today than at almost any point in the last 20 years, and what history says happens next. Gold is sitting at $4,401.50 an ounce right now. Not $3,800, not $4,000, $4,401.50. And yet if you scroll through mainstream financial media today, you will find commentators still describing gold as a niche hedge or a fear trade that rational investors shouldn't overweight. Meanwhile, the entities managing trillions of dollars are quietly doing something very different. Let me show you exactly what that looks like in the data. Start with central banks, because this is where the divergence is most dramatic. Central banks globally bought 1,045 tons of gold in 2023. That was the second highest annual total ever recorded. Then in 2024 they bought another 1,044 tons, making it back-to-back years above 1,000 tons for the first time in modern history. Before 2022, the previous record was 646 tons set back in 2011. So we are now in a regime of central bank buying that is roughly 60% higher than anything seen in the prior decade. These are not retail investors chasing a rally. These are the institutions that literally print money deciding that they want more gold instead. Now look at what retail investors and mainstream portfolios are doing. The standard 60-40 portfolio, stocks and bonds, still allocates approximately 0% to gold as the default recommendation from most mainstream advisors. A 2024 survey found that roughly 79% of U.S. retail investors hold no direct gold position at all, not physical, not ETFs, nothing. That is the divergence in its starkest form. The people who manage the world's sovereign reserves are buying at record pace. The people watching their 401k are not in it at all. Let's get into the positioning data, because this is where it gets really interesting. Look at the CFTC Commitment of Traders report, the COT report, which shows how different categories of traders are positioned in gold futures. As of the most recent data, managed money, meaning hedge funds and large speculators, holds a net long position in gold futures that places them in roughly the 85th percentile of historical positioning going back to 2006. In plain English, hedge funds are more bullish on gold right now than they have been 85% of the time over the past 18 years. That is not a neutral positioning, that is a conviction bet. Now compare that to ETF flows. Gold ETF holdings, the product most accessible to retail investors, actually saw net outflows for much of 2022 and 2023 even as the price held firm and then broke higher. Global gold ETF holdings peaked at around 3,915 tons in late 2020 and fell to around 3,100 tons by mid-2024. Retail investors were selling their ETF exposure while central banks were buying physical tons at record pace. That is not a small divergence. That is a 800-ton gap between what paper gold retail holders did and what physical gold sovereign buyers did. Here is a statistic that almost nobody talks about. The gold to M2 ratio, which compares the gold price to the total money supply in the US, is still below its 1980 peak even at $4,401.50 an ounce. The US M2 money supply currently stands at around $21.70 trillion. In 1980 the ratio hit approximately 4.8% when gold peaked at $850 an ounce. Today at $4,401.50 against a $21.70 trillion M2, the ratio is closer to 1%. That means relative to the money in the system, gold is still far cheaper than it was at the last great bull market peak. Smart money knows this. Most retail investors have never heard of it. Here is the macro context that makes all of this positioning make sense. The federal funds rate sits at 3.63% right now, but the US CPI index is at 332.568, meaning real purchasing power is being quietly eroded. Real interest rates remain structurally lower than through most of the 2010s, and that is exactly the environment where gold has historically done its best work. And the US deficit for fiscal year 2024 came in at $1.83 trillion. When you run deficits that size with rates at 3.63%, the interest expense on the national debt starts compounding in ways that limit the Fed's options. Goldman Sachs, J.P. Morgan, and Bank of America have all issued research in 2024 and 2025 upgrading their gold price targets, with Goldman's latest target reaching $4,000, then being revised again. That is not fringe analysis. That is the sell-side establishment catching up to what sovereign buyers figured out 2 years ago. Several of you in the comments have been asking where gold goes by end of 2026, whether we see $5,000 or something lower. Here is my honest take, and I want to be clear, this is not a price prediction in the traditional sense, it is a framework. Every major gold bull market in history has had a retail capitulation phase where the crowd finally piles in. We have not seen that yet. ETF inflows are only just beginning to recover. Retail sentiment in surveys is still cautious. The divergence between institutional positioning and retail positioning has not closed. Historically, when that gap closes, the final leg of a gold bull market tends to be the most explosive. The 1970s bull run saw gold go from $100 to $850, and roughly 70% of that move happened in the last 18 months of the cycle when retail finally joined. I am not telling you we hit $5,000. I am telling you that the structural setup, the positioning data, and the historical pattern all point in the same direction. One more data point that deserves its own moment. BRICS nations collectively increased their gold reserves by more than 300 tons in 2024 alone. China's People's Bank added gold for 18 consecutive months before a brief pause. Russia's gold reserves now cover more than 27% of its total reserve assets. The global south is not diversifying into U.S. treasuries. It is diversifying into gold. That is a structural demand shift that does not reverse when sentiment changes. Physical tons bought by a central bank do not get panic sold when volatility spikes. This is patient, strategic accumulation. It is the exact opposite of how retail investors typically engage with markets. So which side of this divergence does history say wins? The data is unambiguous over every meaningful time horizon. Institutions that bought gold ahead of retail in the 1970s won. Institutions that accumulated in the early 2000s before the commodity supercycle won. Central banks that rebuilt reserves after 2010 won. The retail investor who sat in a 0% gold allocation and waited for confirmation from mainstream media was always the last one in and the January 1st to panic. The divergence we are watching right now, hedge funds at the 85th percentile long, central banks buying over 1,000 tons per year, retail ETF holders still net reducing exposure, is one of the clearest smart money versus retail setups this market has produced in a generation. Most people will watch this and do nothing, and that is exactly what the data predicts retail does. But if you want to keep tracking this divergence as it closes, subscribe to this channel. Every week we go through the actual positioning data, the COT reports, the ETF flows, the macro numbers, so you always know what the smart money is doing before it shows up on the front page. Hit the bell so you do not miss the next update, because when this gap starts closing, it will move fast. Just to be clear, I am not a financial advisor. I am genuinely just a fellow student of this stuff who finds it fascinating and wants to share the research. Nothing here is personal financial advice, and you should absolutely form your own view based on your own situation.